Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, the number one value investing podcast in the world, soon to be the number one value investing YouTube channel in the world as well, on air with my partner, Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How is it going with you?
It is going great. Good morning. Good morning to you. We hope everyone had a good Monday. I hope everyone had a good weekend. Jeff, the market closed up 7% today.
Wow. Yeah.
Pretty crazy. And all we kept hearing about all weekend was the fact that this week and the next 2 weeks in general is going to be, the darkest weeks for the United States. And market shrugged it off and ripped up 7% today. But the numbers in New York City appear to be stabilizing, which is probably what, helped push the market up. And then at the end of the day, Trump was saying that he's going to look for another couple trillion stimulus package in the market as well. So all good news, I guess, for stocks in the short term. And when I mean short term, I mean, week or two. But before we get into everything, we are going to be doing a Q&A. And to be on the lookout for future Q&As, follow me on Twitter at Focus Compound. If this is the first time that you're tuning in with us, be sure to go to focuscompounding.com, check out all the work we do. Join the Focus Compounding Daily, which we always go over. We have a new schedule, Monday, Wednesday, Friday, of companies that are going to be put up on the website. So Jeff has a backlog, so we'll always have a couple in advance, so we'll know what the schedule is. If any of these companies interest you, join the premium side. And of course, if you're watching on YouTube, hit the subscribe button. So Jeffrey, market closed up 7% today. A lot of, I guess, crazy stuff happened in regards to that. One thing that was interesting to me, so yesterday you sent to me a very long article, which I included in the email because I thought it was interesting, on the fundamentals, the history, and the potential future of the carnival industry, the cruise industry. Mm-hmm. And here's something I'm not sure if you know, but before the market opened today, the Saudis took an 8.2% stake in Carnival Cruise.
No, I did not know that. Yeah.
Yes, the market the stock ripped on this news. They bought up 8.2% of Carnival. Any thoughts on that? I mean, I thought that was surprising. What are they going to do? Buy their ships and throw a bunch of oil in there and kind of use it to store oil? What are they going to be doing with this?
Yeah, we'll see. So we had talked about investing in these stocks after recapitalization, and Carnival's basically been recapitalized. Now, I was doing some calculations. I think all the money they raised, plus the money they had on hand, plus their credit line, would last less than 9 months. So they said that they were burning through over $1 billion a month. And if I add up everything, I think it's not more than about 9 months. So, the biggest part that they did was the 11 or 12% yielding bonds that they issued. But Carnival, which the article gets into, is in a much better position going into this than the other two cruise lines, Royal Caribbean and Norwegian. It had less debt and a lot less debt relative to its assets of all those ships. So the amount of debt that it raised is not big versus the tangible net worth that it had going into this. It's just that it's not producing any cash flows.
It says it right here. Compared to its two chief rivals, Norwegian and Royal Caribbean debt to equity ratios are around 100%. Both took on a lot of debt at a time when debt was cheap, which may prove difficult to pay back during a rough patch like this.
Yeah, I think also in the article they mentioned how much they have in book value of their ships. I think it's over 25 billion. So the fact that they could raise, whatever it was, 6 billion or whatever in bonds isn't that surprising. Given that they have that much collateral. But it does mean that people think they're going to start sailing eventually again, because if they don't, like I said, I think they're burning about $1 billion a month. So, you have to assume that people will be back on cruise ships long before there's any sort of vaccine or widespread immunity in the public. So that kind of has to be the assumption of all those people buying the stock.
Yeah, because otherwise, go ahead.
Otherwise you'd be. I mean, best case scenario, what are you waiting? You're waiting closer to 2 years, 1 to 2 years. I don't know that they can wait 1 to 2 years without having any revenue come in.
Yeah, it's just the whole situation's just been fascinating. And then today when I saw that the Saudis took a large stake in the company, I was like, wow, this is just this story is just continuing to be written, and it's been an interesting story. The next thing that I want to quickly go over before we hop into all the questions, I tweeted out this weekend, and you also sent this to me as well. Vertu Motors, their CEO, Robert Forrester, he gave an interview, and it was like 30 minutes long, on really his perspective of everything going on, and really, building a business for 14 years and then shutting it down, within 2 days. And it was the most honest, sobering interview I think I've listened to by a CEO during this whole pandemic. And I just put it in the email because I think a lot of people should listen to it. I think, and he thinks as well, that business will be changed, forever in some way because of everything that has happened. And I just thought it was just an incredibly profound interview. I thought it was a great interview. Did you like it as well?
Yeah, I like the interview a lot. We accounts we manage hold shares of Vertu Motors. It's a UK car dealer. Yeah, I thought it was a really great interview, and it was interesting some of the things that he said, some of the information that he gave too about what the situation is. They're basically in business right now, servicing things and stuff just to service people who need their cars and vans and things to do work, everything from plumbers and electricians and stuff to people use it for other things too, to deliver stuff. But they're basically saying we're not probably going to be making any sort of money on any of the servicing we're doing or anything like that.
Yeah, he was excited because they sold 2 cars last week. That was the big news.
Yeah, I think that also is a point because a lot of people have said to me, cars and houses both. A lot of people have sent things to me saying, oh, but they'll sell a lot of these online and stuff. People just aren't going to be. I mean, you can put off car and house purchases, so people aren't going to close any of those. So it's even if there's an online way of buying stuff, it's not going to happen. So yeah, he said they sold 2 cars in the last week.
Yeah, and he was, talking about how, the company doesn't have debt, and obviously we know that. But it's interesting, and it's going to be interesting. And I was talking to you a little bit about this last night, how I think I'll probably think differently of risk forever because of this pandemic. Not saying that it's like you're never going to want to invest in businesses that have debt or operating leverage, but like I was saying, I don't know how many people had a worldwide pandemic and economy stoppage in their, risk-based analysis models. You know what I'm saying?
Absolutely, yeah.
And another thing that's interesting is how much more often black swan events happen than people like to think about. But enough with all that. Let's jump into the Q&As. What we'll do is we'll answer all these questions on Twitter, and then we'll also hop over on YouTube as well. I'm just loving this engagement that we've been getting on YouTube. So if you're watching us on YouTube, thank you so much. Continue to comment. That helps hack the YouTube algorithm, and I really do my best to answer every single comment that comes through there. And if it's an investing comment, a lot of times we'll use it for content to go on the podcast. So the first question, Geoff, it says, does Geoff consider mean reversion and use negative historical and relative stock price performance as a starting point to find new ideas? An example, NLS. And he says, given the increased stock price efficiency starting with traditional metrics, Geoff, and then he says, Geoff, gold up again today, $45 at, I'm guessing that means noon. I'm not sure. But
yeah,
that was his question. Yeah.
Yeah, Shadow Stock's an excellent blog, by the way. So let's see. What I really do is I look at how long ago the stock was at a similar price, basically. So I don't necessarily look at, say, like, is this stock at a 52-week low or something, but I do look at, is this stock, I mentioned Hanes Brands, for instance, not that long ago. The Hanes Brands is at a price that is similar to the price it was at in, this year and that year, 2 or 3, only for Hanes Brands, it's very cheap, only about 2 times in its history since it was spun off about 14 years ago. Has it been consistently this cheap? I think in the crisis, it was a lot cheaper. But I look at something like that. So you'll hear me say that a lot with the stock market, with anything like that. Oh, we're back at prices that we're at 3 years ago or something. If we're at prices that a stock like this hasn't been in 10 years or was last in a recession or something, that's interesting to me. So I look more at like longer term. So the fact that a stock's down 80% this year isn't as interesting to me as the fact that it's at a 5-year low or something like that.
Got it. What is your opinion on gold? I don't know if he deleted it, but he asked that earlier, and I can't find that tweet right now, but I know he was asking, which is the reason why he has this GIF right here. because he was asking about gold. And would you ever consider gold as an investment?
I might consider gold as well, I mean, we won't buy it because we focus on stocks, but I don't. So two things. One, I think gold's okay as part of a portfolio. Like I mentioned, like if you're going to have gold and like zero coupon bonds or something in the same portfolio on opposite sides at a small percentage. So if it, not necessarily small, but 10 or 20% or something of your portfolio, the same way that some people use a mix of stock and bonds all the time. But my big problem with gold is you have to do some sort of calculation versus other commodities to figure out that gold is actually reasonably priced. I just can't buy something without knowing what I think the price is versus other things. So if I think that the price is something that people are overly excited about, I'm not going to buy it. And when people talk about gold, they never talk about what the price is. Like, what's the price of gold versus silver? What's the price of gold versus copper? Are those things low now versus what they've been in the past? If you show me that gold is cheap versus, you know, a basket of 20 different commodities, then that might be something I'd be interested in. But if it's just something that you buy regardless of price, I can never be interested in investment like that.
Next question. Have you ever bought or strongly considered a company that has exclusively lost money but is extremely cheap, like a net, and there are signs of profitability?
I don't think I've bought such a stock. I have strongly considered it. In fact, like as of now, I'm considering a stock that had, to my knowledge, not posted a profit. I don't know if it's posted a profit on an annual basis at all yet. It has posted quarterly at least, and it might have posted annually, but it would have had like 10 years of losses or something before that. So yes. However, it's been cash flow from operations positive for a while, and on a free cash flow basis, I would expect that it'll be continuous profitable from here on in. The company's grown, you know, doubles every 2 years or less. So you can imagine that a company
the revenue does.
The size of the company, the revenue, the gross profit even faster than that probably. So because of that, I'd be interested. So I'm not opposed to those sorts of businesses. When you hear me say things about how I don't necessarily like Uber or something, that's a little different. I don't see the path to that. But I think it's a great time to buy a stock that's lost money for most of its existence till now, but has been growing really quickly, and from this point on will make money. But it also has to be in the right industry, and that company is in an industry that I like. So
what's the industry?
The industry is food and beverage.
Okay. Got it. So, because I was trying to see, like, what is it? At what point? I mean, has the business changed at all, or is it just they have reached that point of scale?
Scale, and also there's certain factors associated with scale, like recognition of a brand, ability to be just widely distributed, other things like that. That once you hit a certain point, I feel secure enough in. I mean, there are other models of businesses that I could talk about that I think have the potential to get there at a certain point, and then there are other ones that I just don't see the evidence yet. So, I mean, even
Coca-Cola.
No, the company is not Coca-Cola.
Got it.
Yeah, but then you have to also have the right price. The biggest problem with these is so many of the things that are exciting that way are at too high a price to sales and things like that, and you still have to pay a very reasonable price to sales. These asking more specifically about like extremely cheap, like net nets. Net nets I would not buy if they haven't been profitable. So there is some evidence that unprofitable net nets, in the sense of this current year, aren't making money, are better investments than net nets that have been that are profitable right now. But in general, all the net nets I bought are ones that have been profitable. I stick more close to the kind of net nets that Ben Graham bought. I think net nets work great, and a net that's losing money this year is totally fine. But I would like to buy a net that's been in business for a very long time and has mostly made money. So I'm fine with net losing money this year, though.
Yeah, I mean, they asked that in that thread. Some other people were commenting on Vetla's tweet and essentially saying that they thought you did that with Japanese net nets. But the difference was with the Japanese net nets was they all had 10 years of profitability.
Yes, they did. Yeah. And
I agree with you. Go ahead.
No, you go ahead.
I was going to say, and I agree with you with beverage. I mean, it's like every single beverage company you look at, they're always trading. Obviously, that was a joke about Coca-Cola, but they're always trading incredibly high on evaluation metrics. I mean, if you look at like Monster Beverage, why is that? Is it because the returns on capital are just incredible and the scale and everything, and like that revenue growth?
And the predictability. I think if you look at Monster, not only is it what you call like a growth stock, But in terms of earnings per share and stuff like that, if you looked at it, it looks more like a consistent blue chip type growth too. So yeah, that's a different kind of thing. We had to write up a box on the website, some other things like that. So I would be interested in stocks like that if I saw they were achieving the scale they needed to and they were cheap enough. Unfortunately, at least for the last several years, last 5 years or so at least, companies that haven't been making money but otherwise look really promising are very, very expensive in the market. That's the part of the market that's most troubling to me. Not like Google and Facebook and whatever. Those PEs aren't really high. What you see is very high price to sales ratios on companies that look like they have a promising product, are growing really quickly, but have never turned a profit. Those are extremely expensive.
Mm-hmm. I remember Monster Beverage was actually in 100 Baggers. It's a pretty good book, and was just talking about the history of that business. And it's a good book for anyone that would be interested in something like that. Next question says, is FICO still too expensive for consideration? And any change to your thinking regarding its long-term competitive position?
Okay. Can you get a quick FS on FICO, or will that crash the computer?
No, I'm not. I don't have my... That's why we have the, what's it called? The S&P 500 chart up on the internet now, because I think it'll give me some bandwidth. Bandwidth apparently is, let's put that elsewhere. Okay. Alrighty. Let's see. So it's at $263, 38 times earnings. Can you see it on your screen?
Yes, I can. So enterprise value to sales is 7 times. Yeah, I'm thinking that's too expensive, to be honest. I really do think it's too expensive. They will have a decrease in revenue, presumably for a little while, and then it will tick back up. I like FICO a lot, but I mean, something like close to 7 times sales or about 7 times sales, is just a price that I think is too high. It's not going to be an incredibly fast growing business over the long term. It's been fine, but remember that 10-year CAGR that you see of revenue growth is basically the fastest they're ever going to grow, because that was coming out of a financial crisis. So I just think not, because of that price. You would want to pay no more than, you probably want to pay more like 20 times normalized free cash flow for this business, I would guess. Not really more than that. And, if we look, I'm seeing that you're paying a lot more than that. So it would have to get significantly cheaper. I don't think I want to pay more than 20 times free cash flow for FICO. But I don't see a big change in the competitive position so far. We'll see if that differs over time. But there were more competitive threats in some ways that people thought there were 10 years ago than there are now, because certain things that were competing with them have kind of proven not to be as effective. So I don't think that it's worse than when I bought it competitively, but it's a lot more expensive. So, we're talking about, I bought it at 10 times free cash flow. So, and free cash. So this is 3 or so more times expensive.
But is the business like FICO ever going to be worth anywhere, or be trading anywhere near that? Because if it would, then that means that there's probably huge issues going on at the business.
No, in 2010, it traded at that. In 2010, I think it traded at 10 times free cash flow. So there were not a lot of credit applications and stuff, but the business was fine.
Interesting.
So, and they were buying back stock. So if they buy back stock while the stock's very cheap, that makes it even more attractive. So yeah, but I agree. It may never get down to that price again. It probably shouldn't have gotten down to the price in the first place. I thought it was kind of crazy it got to that price, but in the financial crisis, no one wanted something that scores credit.
Any thoughts on Simulation Plus, SLP?
I haven't.
Are you familiar with the company?
No, I do have it down as the stock to consider. I don't know that you'll get an actual write-up of it. Shall see. The reason you might not get a write-up, I think, is more having to do with price and stuff like that. If I remember right. Let's see. Yeah, so we should mention we're using QuickFS and that we love the website and everyone should sign up for it. But yeah, I just think probably, if I remember right about Simulations Plus, the issue is that I think I'm not going to write up a stock that's so expensive that I know ahead of time that I'm not going to be able to suggest buying it.
Got it.
But it looks good on the numbers, yeah.
Let's see. Have you done any work on HXL?
Okay.
Hexel Corporation. You familiar with the company? P 8 times, 8.8.
I don't
10-year
think so.
CAGR and revenue about 8%. What do they do? They market structural materials for use in commercial aerospace, space, and defense and industrial markets. Interesting.
Yeah, so that would be a problem now. I don't know. I think it'd be very hard. I have written about some companies that might have issues that way, but I've kind of tried to not write about things like Carnival, a restaurant, things like that, that just are basically a credit analysis of, will this company survive? How long can they survive? And when they do, what will it look like? So I haven't really written about companies that have basically no revenue coming in, stuff like that. So I don't plan to write about Boeing or something like that. So I don't think I would write about, I don't even think I would write about TransDigm or something in this environment. So just because it's kind of would feel too, I don't know, it would feel like I'm doing too much analysis of whether this company will survive in the short term and stuff. Then I like to do like a longer term analysis of the company. So maybe in a little bit, if we start seeing some things change with aerospace, I might write about like aerospace companies and stuff again. But right now, I don't think so.
Mm-hmm. Got it. Are you familiar with the stock CIGI?
Nope.
Okay, I don't even know what that company is. Why isn't he long tankers yet? He's kidding. He's wondering if you looked at any mispricings in the energy sector. He says several companies like KLXE to Exxon have been obliterated. KLXE I saw is under $1 now. Let's see. Yeah, it's 76 cents.
Yeah, KLXE has some. If you're interested in KLXE, I believe
market cap 18 million, Geoff.
Okay, I believe they have some. I think they have some bonds out there. So if that's really what you want to do is own KLXE, I think there's more senior securities out there. They had some pretty high yield bonds even when the company was in better shape. Yeah, so no, I haven't, but it is the thing that I should probably be paying more attention to. I haven't just because historically it's not a part of the market that I've ever paid much attention to or enough attention to. But some things are getting very cheap. It would not be things like KLXE though. It would be things that are more on the side of like Exxon or whatever. I guess of those two, it would be closer to Exxon than KLXE. But not that long ago, I still thought they were kind of honestly pretty expensive, the big oil companies, compared to where oil is going to be.
Got it. How do you stress test a company? For example, Starbucks, when revenue has dwindled so much, how long can they survive in this environment without their normal revenue?
That's a very good question. It's very hard to establish. If we go to Quick FS, we can type in Starbucks and see and talk about that. So most companies have never done like an analysis of what would happen if they don't have revenue. Small businesses and stuff usually go out of business in anywhere from, 2 to 6 weeks or something. They'd be out of business without access to a lot more credit. They generally use the bills, they pay the bills that have come in and that they're have a little leeway on paying using cash that's coming in now. Big companies can be in a different situation. So the main things are like companies that have, let's see. So if we look at their, let's see. So we're looking now at their, let's see, growth. Okay, we got their revenue, the gross profit. So obviously most of Starbucks stuff goes into the gross profit line. We don't know a gross cost line, a large amount. So we don't know everything about how much that is, but it's most of the business. And that would mean that you have to kind of analyze what that looks like. I was looking at a company that has 15% gross margins recently, but a significant portion of that is factory overhead. So unless you close the factory, you're still going to have those expenses regardless of how much volume you're doing. Starbucks has closed its stores. So if you're asking how long can they go, has closed many stores and has drive-through and whatever in some cases. If you're asking how long they can go in situations like that, then they can go pretty long. And you could look at their balance sheet, get an idea of how much they can borrow and things like that. You also can always look for credit ratings too. You can also Google for credit ratings on companies that are big because that'll be out there too. In general, I just look at things like how much their quick assets are, things like cash and receivables and stuff, and how much they actually have in liabilities that would have to be paid off, especially maturities of debt and things that are up closer to now. Because I just wrote up like Hanes Brands recently, and a lot of their debt wouldn't be stuff they pay until 2021 or 2024. That's very different than paying stuff now. Starbucks is a little weird situation for me because I don't know what they'll be like when it recovers. Like Hanes Brands, you could predict sales will be pretty normal pretty fast. But Starbucks, for instance, there's a couple Starbucks. There's a couple. It's a pretty saturated market. There's 2 Starbucks about within a third of a mile from me.
Are they both still open?
No. There's
How
something
have you been functioning?
There's I think 10 Starbucks within 5 miles of me in a 5-mile radius. So now the area I'm in might be a little more heavily full of Starbucks than most of the country, but still, the big problem that they have, of course, is that those Starbucks depend. Well, one Starbucks depends on people in a hotel, but on the other one, the Starbucks around here generally depend on people going to the office buildings from work and back. Same thing as all the lunch places. So even before they close down or whatever, as long as no one's coming into work, you've got a problem, and that's still a problem for these companies. So I don't know, but it's generally a business that I think could come back as long as people were working. But without them working, it could be kind of lower. I think they could last a really, really long time, Starbucks. Also, just because I think you have to be realistic about access to capital and things like that. And I think they would not have trouble selling shares, borrowing, doing all sorts of things if they ever got to that situation in a company like Starbucks. So I think very, very good. Situation's different for other companies. So like, say Tesla or something. It's good Tesla raised a lot of money before this happened. It's very good for companies like that they raised a lot of money before. If people don't know that as soon as things open back up, you can generate a lot of cash. If they don't know you have this long history of profitability and stuff, it just becomes difficult to access capital in those ways. So I wouldn't limit it just to what's on their balance sheet and stuff. A company like Starbucks can raise capital, and bigger companies are much likely to last longer than smaller companies. This is something that will disproportionately affect small companies. I've used the word depression before. Depressions are particularly bad on small companies as opposed to big companies. The preference in stock among investors for like leading companies is almost directly a result of what happened in the Great Depression. Before then, there wasn't all this love for the really big companies. Afterwards, the distinction between like big cap and small cap and stuff became very big because of the different experience they had in the Depression. So, and that's just something that will happen here. So Starbucks is well positioned. Yeah, I think we'll see. I think a company like Starbucks will keep paying stuff. I really think they are unlikely to actually be fully shut down for a long period of time.
Because they could just do, drive-throughs and stuff like that.
Yeah, not that all their places are equipped for drive-throughs, but yeah, they could do that. I don't know. A lot of this also depends on A, what rules the governments adopt, and B, also literally how the virus actually works. We know a few things about the virus now, or seem to, that makes it a little more difficult to open up some places than I thought originally. But we'll see.
What are your thoughts on Hunter Douglas? Does the current share price make it interesting?
So this is a rough one. Hunter Douglas is a very good business. However, I would say it does have some issues with the financial position. So Hunter Douglas is the leading company in curtains and shades. And it owns the Hunter Douglas brand and the Luxaflex brand. It also actually owns a couple smaller brands that it bought after the Great Recession too. So it's very cheap. If you go down there, if you scroll down there, I can see the price to sales ratio and the PE ratio. If you go below the video, yeah. So the PE ratio is like under 5 there, dividend 5%, and more importantly, the price to sales is 0.45. Also, price to book is less than 1. So very attractive prices. They have some debt going into this. They have very, very, very high operating leverage. So they have some financial leverage, but they have a ton of operating leverage because it's a vertically integrated company. And what that means is they make each part, they bring in very, very basic parts that they then turn into what you need for curtains and shades. So they bring in like aluminum in a very basic state, and then they turn it into all the different parts that they'll need and everything. This means that there's huge amounts of overhead in their factories and just distribution and everything that they do that is difficult to absorb a drop in unit volume. So while they can maintain margins in many ways at a certain level of volume, they're hurt very badly by volume declines. I think after the housing bust, something like 7% of sales change in their margins was, by my estimate, due simply to a decline in unit volume. They are a big part of the industry, so the industry's decline will cause that for them. There's just as people aren't buying cars right now, people aren't moving into new houses. They don't really do apartments and stuff. Hunter Douglas is not kind of the area they focus in on. They focus on their customers are mainly women from about 30 to 65 or so who have just moved into a house or who are renovating a home or maybe redecorating in some rare cases part of the house. I think they'll put off those purchases and stuff. And so I think Hunter Douglas will have to figure out some sort of liquidity things. I think this will be difficult. I think potentially this could be worse for them than the Great Recession, even though they're a housing driven stock. They survived that. I mean, they continued to make a profit and stuff in that situation. Their earnings were down a lot. Their return on equity and stuff was suffered for a very long time. They took about 7 years, I would say, of really under earning before they got back to anything approaching normal, because half their market is the US. And I would say for about 7 years, household formation of actual houses, not apartments, really didn't increase. So it'll be tough. It'll be a lot like the last one, but this will be, I think they have more of a difficult financial position. So, but the stock's cheap.
Mm-hmm. What challenges do you guys see on franchise chains such as restaurant brands or MTY Foods? Is it just a matter of liquidity since franchises have an okay biz and properties have okay tenants? How could this equilibrium break if it looks like a lose-lose for everyone to do so? Thanks, lads. And then asked if we have any justification to Wendy's valuation. So I guess maybe just a good short version of that is, what are your thoughts on QSR restaurants?
Yeah, so the QSR restaurants that are franchised, this is a bit of a problem because the pain will be felt mostly by the actual operators of the franchises. So I don't know the answer to that, but this has been a problem that's been developing for a little while. They've done better, companies like Restaurant Brands, than the people who are actually running their restaurants. So I think that there definitely has to be a lot of sharing of the pain, with the bigger company being expected to do a lot of it for their smaller franchises. They can't lose them. So I think that, yeah, that's one area that have to be worked out a lot. Even when we're talking about Virtue Motors and stuff, they're not franchised, those companies, but car manufacturers do have to do a lot to keep their dealers in business, because otherwise you lose access to the market. They need their dealer system. Restaurant Brands isn't worth anything without the actual people operating their stores. So I think I think that so far from what I've seen, it does seem like the operators of the actual franchises, there are a couple of publicly traded ones, have reacted really badly as compared to the companies that are that give out the franchise. So a company like Wendy's or something, I think, has done better than, say, a company like, Carol's Restaurants or something. And there are other ones. There's Meritage, I think, has a lot of Wendy's franchises. I think Meritage Hospitality does. So you could compare it to things like that. Yeah, Wendy's that looks pretty expensive.
How do you figure?
How do I figure?
Yeah.
Well, I mean, now this could be leverage, that people are okay with the leverage, but on an enterprise value basis, that's 3 times sales, and their EBIT is only about 9%, if I'm reading that right, on average.
Yeah. The margin.
Yeah, now the margin has improved a lot that we're looking at here, but I would say this stock is not priced for any sort of cyclical downturn. So, I mean, it looks, I guess it looks okay. It looks fine if they keep the leverage they have in this past year is what they'll have forever, but.
Mm-hmm. Is there a sector that you foresee the next bubble coming in? I'm guessing, go for it.
No, I honestly don't think that there's going to be any bubbles right now, because I would expect that it's hard to build up a bubble at a time like this.
Yeah.
So generally, no. I don't think so.
He also asked if there's a product or service in the United States that you could see grow in emerging markets in the future. For example, food delivery, etc.
Food delivery could grow everywhere. It could grow a lot in the U.S. too. I think I said I may have said in a thing about Uber that I thought that the food delivery thing was more promising than their core business. So yeah, the food delivery thing amazes me, all the data that I see on it and stuff. So it's very interesting.
What amazes you about it?
How many people use it? How, especially younger people, how expensive.
Do you know who their number one customer is?
You.
Yeah, me. But ever since they can't ever since Postmates or Uber Eats, my building won't let them come upstairs now. Now I have to meet them downstairs. Now I've been cooking in way more. Doesn't that show how lazy I am? Good Lord.
Yeah, so it's been estimated it's about 100% more expensive on average, total when you add everything in. It will not help restaurants. Restaurants themselves will not benefit from this for various reasons. It increases competition among restaurants and stuff, so it's not good for restaurants. But it is good for the companies that do the actual delivery. So the platforms that they use. Yeah.
Yeah, I love home delivery. It's always interesting. So, like when my mom visited to Dallas, she was kind of like, oh, wow, you use home delivery a lot. And it's just so easy, to use Uber Eats or Postmates with the phone, because obviously we're in Dallas and everything is within minutes away. But she lives in a town where I grew up in Illinois that has 6,000 people and everything's like 30 minutes away. Any sort of civilization. But no, I love home delivery. I would definitely be bullish on that.
Yeah, I don't think I've ever used it, to be honest. I'm trying to think. I've never used it.
You haven't used Uber Eats or anything like that?
I've never used home delivery. Well, technically, I've used things like that to have the order ready to pick up myself. Because a lot of that's a big part of this, is that a lot of companies, don't want to have aren't going to use their own websites and stuff to do this. So even when they have just a carry out business, they're going to do it through something like that. That's one of the reasons why I think that's potentially a good business and stuff. But, we'll see. It basically is a software thing. Yeah.
Yeah. How do you assess business durability and predictability in times of coronavirus? So probably maybe a good way, like how would you handicap everything going on and whether the business will be, predictable and durable and be around?
I think business durability and predictability isn't that dramatically changed. It's just a question of whether they get through the next few years. I know a lot of people are saying that some things will be forever changed. I think some things will be somewhat changed. There'll be some change in work from home. There'll be some change in banks not needing as many branches and doing a lot more digital banking because people will get used to certain things. But other than that, I think many of these things will be more. I think things will be more normal than people expect in, like, say, 2023 than they're realizing right now. Compared to most people, I think things will be more like it was before in 3 years from now in terms of all the stuff that has to do with actual businesses, with people. On the other hand, I think that the risks for the next year or two are significant for businesses. There could be shutdowns all the time with certain kinds of businesses. So everything from restaurants, gyms, theme parks, whatever, there's huge risks to them surviving the next couple of years. But if you can get out of that, you're fine. The problem is dilution of your stock.
Mm-hmm. With super low historical yields, do you think dividend paying stocks will become tomorrow's new growth stocks, selling for higher multiples?
It's possible. Actually, that is one thing on which stocks are very attractive now. Stocks versus government bonds have very attractive yields. Stocks, a lot of good stocks yet against long-term corporate bonds don't. But if you do see the point where you have attractive stocks yielding more than long-term corporate bonds, then I would say that those stocks are very attractive and people will bid them up. So it's definitely possible. And I've seen some that are getting to that point with yields. You have some pretty safe companies now that yield 5% or something like that. So when things recover, I would expect that they would do very well. Yeah.
Mm-hmm. Would you go long gold right now? We got a lot of gold people ask questions. Which private companies do you admire and would love to own?
Why don't you take that question?
Rolex. And I know Buffett has said if he were to, he would acquire Rolex in a heartbeat if they were selling. When you talk about the brands and everything like that.
Yeah, there's a lot of companies I'd be interested in seeing their financials. Like one company here, there's a company. Are you familiar with Buc-ee's here, Andrew, in Texas?
The gas stations?
Yes.
Yeah, so everyone's obsessed with it.
I would like to see their financials. I don't know that I would like to own the company and whatever it is, see everything about it. But I've been in some. I've thought about the business. I think it's very interesting. So if people don't know, they're mostly just in Texas. They've expanded a little bit outside of that. But look it up, see what it looks like. It's Bucees, right? The picture's a beaver on the front of it. So figure that one out, people, and decide why I'd be interested in that. But I have never seen the financials or even read an article that discusses the financials. So if anyone has an article about it, that would be interesting. But that's
people in Dallas are obsessed with Buc-ee's. They're like, oh my gosh, we got to stop off at a Buc-ee's. And you don't really see them in popularized areas. It's always if you're on a road trip or just like in the middle of nowhere.
Yep. It's road trips between things. I went from Dallas to San Antonio, which takes you through but past Waco and Austin and stuff. And yeah, there's a lot of Buc-ee's and stuff. I think the closest one to here feel like is it Melissa, Texas or something? It's not even that close to me. I don't know if there's another one closer to you in Dallas, but they've generally not been the major metro areas. They're like a road trip type place. But yeah, I'd like to see their financials.
It's like a Walmart with a freaking gas station. It's so funny. All right. Yeah. Looking at BRK.B, I'd like to know if you would consider buying the B shares as a Canadian, considering the exchange rates and other opportunity in the market at the moment. So would you recommend Berkshire B shares to a Canadian investor?
That's tough. Can you get me the quote on the US dollar versus Canadian dollar?
1.41. $1 US equals 1.41 Canadian dollars.
Yeah, and just click the 5 years so people can see what we're talking about here. So down there, 5 year. Yeah. Mm-hmm. So you can see what the problem is there is that last part, and that's why this question is being asked. That last spike up, it means that the US dollar has risen a lot versus the Canadian dollar. That's a little tough. I was talking to someone recently about this. Without hedging, you do have the problem that if you're taking money out of a country that I think is pretty cheap and putting it into another currency, over time, you're going to lose money on that. I don't know how much that matters because Berkshire's opportunities for deploying its cash have increased a lot. I think I'd be okay with that. Yeah, if you were going to, I think I'd still be okay with that. Buying Berkshire if you're Canadian, yeah.
What areas do you expect 3D printing to disrupt?
I don't know enough about 3D printing. I have used 3D printers. I've used some pretty expensive 3D printers and stuff. You'd be surprised. But
you have?
I don't. Yeah.
What'd you make? Like a little action figure or something?
Yeah, you can make all sorts of things with them. 3D printers, I don't know. The thing is, I'm not seeing the stuff that's meant to be used in industrial stuff. 3D printers are something I don't understand and just don't know about the promise versus the hype at all.
What are some of your mistakes of omission?
Well, the biggest thing is I haven't bought stocks that were very attractive other than the fact that they had debt. So.
Wait, please, let's unpack that. What do you mean?
Companies that on an enterprise value basis were cheap. I thought they were very attractive, but they had some debt or a lot of debt. Not necessarily debt that was coming due soon. I thought they would survive and whatever, but a tendency to avoid certain companies that had a lot of debt, particularly in crisis like in 2007 to 2009 and today. What would be the most common thing that I would do is overlook a stock that could be bought cheaply on an enterprise value basis, but has debt and stuff. So an example of that, not that I will not buy it or will buy it or whatever, is the write-up I did of Hanes Brands, which basically I said, I think the company will do fine because it doesn't have to pay these things close soon. And I think it's reasonably priced versus enterprise value, something like 8 times free cash flow at enterprise value or something. So if all that debt was stock and it was trading at 8 times PE and had no debt, you'd probably buy it. But because it has a lot of debt, then you might overlook it. And so I would say that avoiding stocks with a lot of debt is probably the biggest one. But avoiding stocks with a lot of debt is also how I avoid big mistakes too. So I'm not saying that changing that is necessarily a good idea, but there have been cases where if I didn't buy something that I knew I should have, a big reason why is that it had debt.
Got it. Next question, Terry Smith of Fundsmith says, return on capital employed is the most important judge of business quality. How should we think about and calculate return on capital employed?
I think that is the most important, although I think judging the durability of a business is more important than the quality of it. The way that I would calculate it is the way that I did in the newsletter that I did a long time ago, which is basically you take receivables, inventory, and property, plant, and equipment, add them all together. You subtract out accounts payable and accrued expenses, deferred revenue too, if there's deferred revenue, to see what is really in the business. Now, some of these businesses, like the ones that Terry Smith is buying, are very big companies that acquire other things and stuff. Then you have to have a whole different calculation based on their returns on their acquisitions. But the core business is basically what you see in the magic formula. It's basically just those 3 things I said, which are receivables, inventory, and PP&E added up together. And then netted against that is accounts payable and accrued expenses. What's left over is your capital employed. And then you could use something like EBIT, or I care a lot about things like free cash flow and stuff too. But the most I
was going to say that we did a whole YouTube video on that, going into it and doing the math behind it. So you could definitely check that out. think we did return on capital, return on invested capital, and return on equity, and how you would think about it.
Yep.
What is the reason behind CSVI stock split in May of 2019, and why did the share what do you say? And why the share price was not cut to half right after this 2-for-1 split? Instead, it went up from 32 to 40. You can't remember that, Geoff? The stock.
Yeah, I do.
Like crazy.
So stock markets aren't efficient.
Yeah.
In theory, yes. So the reason for the stock price split is they like to keep their stock in a certain trading range, basically. For whatever reason, cultural, whatever things, certain companies don't like the idea of a stock going to $100 or something. And eventually that would happen if you didn't split your stock. So some companies don't split their stock. Berkshire doesn't. A bunch of other companies don't. But a lot do, and that's the only reason for it. And yes, splitting the stock sometimes gets a lot of people interested in it. It did in that case. People got interested in computer services. So yeah, it went up a lot the day that it split because it wasn't adjusted correctly. On the other hand, I do have to point out that we did notice that most websites, or many websites, did not calculate the split correctly. Computer services doesn't file with the SEC. And the dirty secret is that a lot of websites don't subscribe to getting data that isn't SEC data. They just pull the SEC data that's free. So in general, I would say whether it's computer services, Monarch Cement, any company we talk about that doesn't file with the SEC, do not trust data that you get from any website about that company. It could be wrong. So generally only trust, I mean, be careful trusting any data from a website, but websites tend to get SEC data correct and not other stuff. So part of it could have been that the stock's overlooked, the market's fairly inefficient, but there is a tendency for stock splits sometimes to cause jumps in the stock price. That one was dramatic. Some people see it as a vote of confidence from the management that, well, our stock won't drop a lot because otherwise we wouldn't have just split it.
Mm-hmm.
You know?
Yeah. Why do you think Buffett brought down his stake below 10% in airlines? What do you speculate his big move to be?
I think it's just the reporting requirements is why we saw it go below 10%. And my guess would be that he's going to sell out of all the airlines. Generally, when Buffett wants out of something, he just gets out. So I think the reason why we saw it in those airlines is because he'd have to report very quickly if he owned over 10% of them. So that's why you saw it in those airlines right away. But I don't know. There could be some other reason, but my guess is he just wants to dump all of it.
Well, and then the gentleman also asked, you said you don't focus on commodities. However, hypothetically, what would you make of a commodity like sugar in a developing country where a lockdown scenario does not disrupt demand? And they said like oil, as it is deemed an essential. What happens to price? Maybe flawed analogy. Sorry.
Well, the price of lots of things won't drop as much as oil. Oil is the one that's most concerning. I don't know enough about sugar and what it would be in and whether enough things will be planted. It's just a comparison of that sort of thing. There's also tariffs and things with sugar and all sorts of complicated things. So I just don't know enough about sugar, obviously. It goes into plenty of things that we wouldn't think of right away. The commodities that would hold up the best, presumably, to be honest, are things where there might be some sort of supply disruption. So you would have to know more about farming and stuff. But a logical one would be anything that requires large amounts of labor from a different place. So like migrant labor or something could be seriously affected because let's say you're producing something that relies heavily on migrants coming in from Mexico or something into California. If you need that and then there's coronavirus outbreaks and things like that, you might not get that labor. If you don't get that labor at that time, you won't produce as much. It'll be like a natural disaster hitting. It's kind of like how a freeze would spike prices of orange juice and stuff if parts of Florida froze. So same sort of thing if there's a labor shortage. So the commodities I'd expect to hold up the best would be things where there's some sort of supply disruption, probably caused by not having labor when you need to pick things.
Got it. We'll head over to YouTube to answer some of these questions. Someone's asked about your thoughts on Otis now that it's spun off. He said that he remembers that you said you like elevator companies, which Geoff does.
I do like elevator companies, so I would be interested in Otis.
So have you looked at Otis yet?
No, I've not looked at Otis yet.
Got it. And then another question, which we haven't talked about in a while, he was wondering about Hostess Brands and what our thoughts were on the company.
Yeah, so we could look at the price on that one if you, so let's see what the price is on that. This is a company that has a lot of debt and keeps buying things.
Yeah.
Yeah.
So it's at $11.15. Hasn't really moved over the past, couple of years. It's been just
No,
in a range.
hasn't moved dramatically.
I wonder where the warrants are at. Let's see.
The warrants, let's see. Okay.
Assuming this is right, it says 57 cents.
Okay. The reliable one is OTC markets, but yeah, that could be right.
Oh, right here, 68 cents.
68 cents, yeah. So you can buy two of the warrants together. So in this case, less than $1.40 would allow you to buy the stock at what, $11.50. Is that right? Yeah. So, you know, given that together, you could buy the stock at effectively like $13. Those warrants expire in about 18 months from now, roughly. I think I like the core business as much or better than I thought I would of like the Hostess brands, but what management has been doing from capital allocation and how they finance things and stuff, I haven't liked as much over time. So I've gotten less and less interested in the stock. But the core brands, you know, the selling of Twinkies and cupcakes and whatever things, I think has gone really well.
Is that a company that you'd ever be interested in?
It's a business I'd be interested in as it's currently structured and current capital allocation stuff. I don't think so, but in a different form, I'd be interested in the brands. You know, Hostess brands, I'd be interested in. Yeah. I mean, if we could just show people like on Hostess what the debt situation is and stuff, maybe. So if you just, yeah. So if you look, right, you're seeing, so you can see, let's see where we have information on this. So like the, so see how it's not really that cheap. So on a leverage basis, it looks, you know, potentially interesting for a food company, right? But then it's carrying a significant amount of debt on top of that. It just isn't really that cheap, I don't think. And I'm not so sure about the acquisitions and stuff they've done. But yeah, the market share gains that they've had in their core brands, I think they've outgrown what sort of you would expect for that kind of thing. I think that the brands are interesting. I like the brands and the position that they have, but the company as structured right now, I don't love.
Got it. And then the last question that we could go over, because this guy has asked a couple times, is doing a snap judgment on Jewett Cameron Trading Company. We looked at this business before. Yeah. We actually did a snap judgment on it, and I'm guessing it's fallen. So he's asking about it. It's got a market cap of 20 million, currently trading $5.25, a PE of 12, EV to free cash flow of 1.8.
So this company looks very, very interesting to me. It has looked very, very interesting to me for a very long time. I've read their filings. If someone else knows a lot about this company and wants to tell me about it, wants to send me whatever research they've done on it, if they found write-ups about it online that they think are good and go beyond the filings and stuff, I'd love to see them. If there's stuff I haven't uncovered online about it and you could get those to me, then I would be happy to write it up. However, I've had it on a list to write up many times based on the numbers, but I've read through and just found that there is not enough information about this company for me to get a handle on the business and the competitive position and things like that. It's just one of these companies where I read the description of the business and stuff, and it's not sufficient for me to get an understanding of the economics and everything with it. It's just sometimes happens with smaller companies. This is a very small company that they reveal very little about the business, and I think they're revealing kind of too little to explain to me how this business works and stuff. I'm sure that if you could sit down with management and talk to them about the business and stuff, you could get a good idea of whether there's something attractive or not. So this is probably a stock where scuttlebutt and things like that would be very, very effective. This is just sort of, I think the information out there and stuff, I would not be surprised if this is an inefficiently priced stock, because the information that I see is not sufficient for me to make judgments about it. It's not even really sufficient for me to do a write-up of it that I feel okay doing. It's way too speculative. Not that the company's speculative at all. On the numbers, we can see lots of things that would say it isn't, but I just mean my understanding of the business is not good based on what information they provide.
Don't they like make fences or something like that?
Yep. They make stuff like that.
Yeah. So every time this company always comes up on our screen, and I feel like it's one of those businesses where it's always been cheap and it's always looked cheap.
Yeah, but if we can go, let's see, can you go to like, try OTC markets? That should work. So, because this is an OTC stock. So if you go to otcmarkets.com and that should be the one where you get the most reliable long-term chart on it. Yeah. So put in their ticker and then Go to the longest term chart they have, which is max down at the bottom there. Yeah. Okay. So as you can see, it's not a bad performing stock, right?
Yeah.
It's been, if not a net, very close to a net plenty of times. There's all sorts of things about it that suggest it's attractive. But if we go to if you click that one that says announces first quarter financial results under the news section.
There you go, Geoff. You got a Seeking Alpha write-up right here.
Yeah, I've read write-ups.
Results not cheap, or I'm sorry, not good, but nevertheless cheap.
Yeah, I need more of a description of the business there. So, yeah, I mean, I will try to read about it. I'll try to read what they say. I find it very difficult. Here's how they describe their business, right? So they say the business consists of manufacturing, distribution of that whole section there. Yeah, the company's brands. Okay, so I know that they make things for animals. I've got lots of things about that, right? The fencing products that you mentioned, all that. It's pretty difficult for me to understand this business well enough. I'm not saying that I can't, and you could buy it certainly as things like when it's a net, it's just that. It's something that Ben Graham would buy as one of 100 things and stuff in there. I have no problem with that. If you own 30 stocks, you could buy this and throw it in there among them when it looks attractive. But if you're trying to do an analysis of the business and whether you want to own this forever and stuff, I found it really difficult. There's nothing negative about the business. It's just I just am not finding enough information that I'd like to have if I was going to own this business. So understanding the business and not just the financials has been the difficulty for me with this stock. I'm very aware of it. It's been brought up many times. There's a reason you haven't had a write-up about it.
Yeah, that's fine. I looked at it a couple times, and to me, it just didn't seem like I don't know. It just didn't seem like an operating business. I mean, obviously it is, but I agree with you. It seems like they're kind of shotgunning it, doing a bunch of different things. It's like they're doing wood products and then building fences for dogs or animal houses, just a bunch of different stuff.
Well, they've been very successful. If you look at the numbers, in terms of their returns and stuff, if you just compared to other people with how much leverage they use, the business has been plenty successful. So there's something that they're doing and they're doing right. I just have a difficulty understanding what that is and where the success they have really comes from. So I just don't have a good understanding of the business yet.
Yeah. So the question that got sent out in the Focus Compounding Daily, somebody asked you, why do you sometimes price a stock off of its free cash flow yield plus growth rate instead of just using its PE ratio?
Yeah, I gave a quick answer to that, but someone was asking that, and I understand because people talk a lot in terms of earnings yields. So they say if a stock's trading at 25 times earnings, that's a 4% earnings yield. I never seem to do that. What I do instead is talk about this hurdle rate. We often use 10%. And then I say, how much is it growing and how much do I need in yield right now? So the point of that is, let's say a company was somehow growing more than 10% a year. Then you could justify a very, very high price. If it was growing almost nothing, then you have to have a yield of close to 10%. So the combination of free cash flow growth plus yield is what really matters. And to compare that for people, the logic to that is, to me, free cash flow, the actual amount of how I calculate free cash flow, the actual amount of that is your capacity to pay dividends. Whether you paid the dividend or not, whether you bought back stock, did an acquisition, paid the dividend, hoarded the cash, whatever, your free cash flow for the year is the number I really care about as being what you could have paid in a dividend. Well, there are stock valuation models, very old ones and very theoretically correct ones, which operate on the basis that your return in a stock is your dividend yield and then the growth of that dividend. And then, you can do all the stuff of discounting it with net present value and all that. But basically, a stock is a stream of dividends, and then you value it back to the present. So I just treat free cash flow as being what you could have been paid in dividends, whether you were or were not. And then growth in free cash flow as being growth in the capacity to pay dividends. So if you want to think of it, it's like me saying, here's a stock that pays a 4% dividend yield and grows at 6% a year. But instead I say it has a 4% free cash flow yield and grows at 6% a year. It's the same thing to me, because I think over time, free cash flow, as I calculate it, which we got to mention, for people who are newer and stuff, we're not talking about EBITDA or something. I'm talking about cash flow from operations, which includes changes in working capital and everything, less all property, plant, and equipment purchases, including those for growth. So this is money that's really available to pay dividends. So that's what you could be paid in dividends and then how much it grows. So it is just a dividend growth model, basically. But it's using free cash flow because I think that's cyclically over a long period of time the correct number to use. And it's also better to use for things like, say you had Apple or Google or whatever, you'd say, well, they don't pay a dividend, earlier on in their history, so they're not worth anything. Well, they are worth something because they have the capacity to pay a dividend soon, and eventually they will, or they'll use it to buy back stock or whatever. I think that's the approach that I like to use. And in almost all the successful investments I've had, it's honestly been about the free cash flow and the free cash flow growth. So it hasn't been about other things. So that's the approach I use. And then the discount rate thing is this here that you see, like the 10 minus 6 equals 4. The assumptions made here are very, very similar to a DCF. I just think it's simpler. You can do the stuff in your head. I think it's pretty simple. It's kind of the simplest way to have something that's very similar to a theoretically correct way to value a stock. And you really can do the stuff in your head. Anyone can do 10 minus 6 equals 4, flip things into reciprocals and stuff like that. That kind of thing is not difficult. Whereas doing a DCF is going to get you taking on an Excel sheet.
But for businesses that, let's say, are growing faster than 10%, right? Because earlier you said you could pay more. I mean, for a business that's, let's say, growing free cash flow by more than 10%, I mean, how much would you be willing to pay for a business like that? Everyone's always looking for, like, the black and white.
I know people ask this. Here's the problem. The valuation that I just described is for what is essentially a perpetual bond. Okay. The problem is that I don't use estimates of more than 10%. Because while I understand that people have things that are growing, I mean, I mentioned the stock, I didn't say the name of the stock, but I said the stock doubles every 2 years. It doubles every 2 years for now. In 20 years, it won't be doubling every 2 years. I've mentioned many times that Facebook and Google and stuff grow a lot now, but they'll be most of the market in a decade or less. So they'll be almost all the market. So they can't grow much at all after that point. So the answer is you have to use a long-term number that I believe it can continuously grow at. OTC markets is a really good example because people ask about that, and I said 6%. If you look at their history, OTC markets has grown quite a bit faster than 6%. It's just that I don't believe when they are a fairly mature company, they can grow faster than 6% a year. But I do believe something like OTC markets, which is essentially like a stock exchange, it's essentially an financial information provider, can grow a bit faster than nominal GDP. So I really do think it can grow at 5 or 6% a year, even if GDP is at 4 or 5% a year for the long term. So that's the kind of thing where I can predict that. A lot of things Buffett buys fall into this category. He's owned things like American Express and stuff, which have continuously grown faster than the economy, but have never had or have rarely had periods where they grow very, very fast. So that's the kind of growth that's easier to predict. The things that are growing more than 10% a year, yes, they're growing more than 10% a year now, but that can't be the terminal rate at which they grow. It just won't be. So it's also an explanation for why I really like things like smaller banks and insurers that I think have a good business model. They're my favorite thing of all to buy because they could grow like 5 to 10% a year forever, 10% a year, sometimes forever. They're I say forever, but 30, 40, 50 years. The comparison I give is something like Progressive when people ask about this. So Progressive can actually grow faster than the economy for longer than many of the big tech stocks and things you have, because Progressive is a very small overall part of the auto market share, and yet it grows at a good pace. But it could never grow at 20 or 30 or 40%, but it can grow at 9% a year for a very long time, longer than people think. So there's a bunch of stocks in that category being able to grow 6, 7, 8, 9% a year for a couple decades. And those are often the ones that are attractive. I'm always using the rate at which I think it'll grow for a very long period of time, and not just 10 years. I'm talking 10 years and beyond. And so when I say that OTC markets could grow at 6% a year, I mean it could grow at 6% a year from 2020 to 2040 or 2050. It's not impossible.
The result of that, you're willing to pay a higher price for that today.
Yeah, which is what I said, 4% there. So that would be 25 times free cash flow. Yeah. So I on the other hand, I would, for companies that grow very fast, the way I do it is I calculate out how much money I think they're going to make in 5 or 10 years, probably more like 5 because it's harder to predict 10 years out, but, and then price off what I'm paying now versus that. The way you could do it is you use your discount rate of 10%. And so you do the math on that. So like, say $1 today at 10% a year discount for 5 years would mean that you need about $1.60 or something to justify that. So in other words, getting $1 of earnings today, or let's say $1 of sales today. So getting $1 of sales today from this company, I can justify paying a higher price if I can get $1.60 of sales from them in 5 years. Basically, that growth that they have is just paying me for my time, because I need to get 10% from someplace. So the fact that a company will grow at 10% a year for the next 5 years, that's okay, but all that does is pay me for my time. If I get no yield off of it, because I expect to be paid 10% a year. So you need to grow faster than that otherwise. But yeah, I talked about a company that's doubling every few years. All you would do is say, okay, do I think they can double every few years for the next 3 years, or so, the next 6 years or something? So can they double 3 more times? Yes, then I price it off of that. And then I think from that point on, what will the company look like? I'd never think, oh, this company can grow 50% a year for 10 years, you know?
Mm-hmm. Sure. Cool. Well, I want to thank everybody so much for tuning in with Geoff and myself on today's podcast. Geoff, good job. This was a longer podcast. We are going to be doing these every Monday. So follow me on Twitter at Focus Compound, and be sure to be on the lookout on Mondays when I do a call for questions. Also, if you're watching us on the YouTube side of things and want to ask some questions as well, leave a comment. What I've been doing is just queuing the questions, and we will revisit them every single Monday. I want to thank everybody so much for tuning in with Geoff and myself. We will see you in tomorrow's podcast. Take care.